Welcome to this explainer, where we're basically stepping inside the ultimate control room to see the institutions making decisions that affect billions of our lives. You know, behind every economy, there are these hidden forces that can make borrowing cheaper or way more expensive, push stock markets higher, or absolutely send them crashing to the ground. Today, we're going to look closely at the people and institutions that try to keep this massive financial system stable, and we'll see exactly how they attempt to pull the invisible levers of power.
Okay, so let's just dive straight into this massive question. Every single day we hear about interest rates, the stock market, taxes, but we rarely stop to ask who is actually pulling those levers. We absolutely feel the effects when our grocery bills rise or when our monthly loan payments jump up. But how much power do the people in charge genuinely have over these forces? Can anyone truly control a modern economy?
To figure out how this giant invisible machine works, we're going to break this explainer down into 5 clear parts. Number 1, the price of money. Number 2, managing fiscal policy, which is actually going to be our main focus today. Number 3, the regulatory referees. Number 4, the illusion of control. And finally, number 5, the power of expectations.
Part 1. The price of money, central banks and monetary policy. Let's start with institutions like the Reserve Bank of India. They don't just print money, they manage the entire environment in which that money moves.
The really crucial point here is that central banks use monetary policy as a tool to control the literal price of money. They do this by raising or lowering interest rates when inflation gets a bit too hot or when economic growth slows down. Now, they don't control every single rupee in your wallet, but they do set the baseline conditions for the entire financial system. It's like they're building the foundation upon which everything else in the economy has to sit.
Let's put this into perspective. Imagine you want to buy a house and you need a 50 lakh rupee home loan. You're using someone else's money, right? And the interest is simply the price you pay for that privilege. Well, when the central bank raises rates to fight inflation, this exact loan becomes much more expensive, which directly changes your behavior. You might look at that new math and say, actually, scratch that, I'm going to delay buying the house. A business owner looking at a similar loan might delay building a new factory. And as millions of people independently change their behavior, the entire economy predictably slows down.
Now here's a really fascinating contrast. On one hand, we have a central bank essentially altering the financial weather from afar by tweaking the cost of borrowing. But on the other hand, we have the government, which can actively drop cash right into the streets. The government has a totally different set of tools, and they use them to shape the economy directly, not just by changing incentives, but by taking direct, physical action.
Which brings us to part 2, managing fiscal policy, the government's control panel. And this is our main focus today, because this is where the government wields massive, direct power over the economy.
Unlike central banks that just kind of tweak the financial weather, governments use fiscal policy to physically build roads, fund welfare programs, or drastically slash taxes to force economic movement. It's basically the difference between a nudge and a shove. When a government passes a massive multi-billion-dollar infrastructure bill, they aren't just hoping people will spend money. They are physically mobilizing thousands of workers. They're making sure concrete is poured and steel is laid. A sudden tax cut can literally leave billions of dollars in the pockets of consumers overnight, radically shifting the direction of a struggling economy through sheer brute force. Think about the fiscal stimulus loop like this. Step 1, things get bad, unemployment rises, and a recession is looming. Step 2, the government steps in and spends big on heavy infrastructure projects. Step 3, that new money hits the real economy. Suddenly, construction companies are hiring. Those new workers get paychecks. And Step 4, they take those paychecks and spend them at local grocery stores, restaurants, and car dealerships. Then, the grocer and the car dealer have enough profit to hire staff of their own. It is this incredibly powerful direct multiplier effect designed to shock a stagnant economy right back to life.
But there is a massive catch. Because every rupee spent on these huge projects is very often a borrowed rupee. Governments find themselves constantly trapped in this brutal balancing act. They have to save the economy today without creating a severe debt crisis tomorrow. If a government is too cautious and spends too little, the economy might just continue to collapse, causing widespread suffering. But if they push those fiscal levers too hard and spend completely beyond their means, public debt skyrockets. They end up passing an astronomical bill to the next generation, risking the total collapse of their currency. This right here is the absolute core dilemma of fiscal policy.
Part 3, the regulatory referees, setting the rules of the game.
While central banks set the price of money and governments manage the heavy spending, this third group acts as the referees. They don't try to speed up or slow down the economy. They're just trying to keep it safe.
We have different regulators overseeing entirely different sectors to basically reduce fraud and risk. Whether it's SEBI protecting investors in the stock market, IRDA handling insurance, PFRDA for pensions, or the RBI regulating the banking system, their main goal is order. But the thing is, regulators are almost always playing catch-up. Markets are constantly inventing new technologies and bizarre financial products. So while these referees do their absolute best to blow the whistle, they're usually sweating over how to regulate things like global crypto exchanges or meme stock trading algorithms long after the game has already started.
Part 4, the illusion of control, why the machine fails. So, we've got these three powerful groups in the control room, right? But we are about to uncover a massive, unavoidable limitation in their power.
We love to think of the economy as this perfectly predictable mechanical engine with a single control panel that politicians can perfectly tune. We imagine pulling a lever here guarantees a specific result over there.
But in reality, it is absolutely not a machine made of predictable gears. It's a living, breathing network. It is made up of billions of messy, emotional, daily decisions made by consumers, investors, and businesses that are just constantly interacting and adapting. Every single day, people decide to save, spend, panic, hire, or fire based on their own unique realities.
And that brings us to the harsh limits of the control room. A decision made in a central bank today might take 6 to 12 months to actually ripple outward into the broader economy. And during those months, a brilliant policy on paper can be completely destroyed by reality. External shocks, like the sudden outbreak of a war, a global supply chain crisis, or even a literal hurricane wiping out crops, can derail everything. A central bank certainly can't control the weather, and a government can slash interest rates to zero, but they literally cannot force a terrified business owner to take out a loan if that owner is worried about the future. Which leads us perfectly into part 5, the power of expectations, the invisible antagonist. This is the final and perhaps the most uncontrollable variable in the entire financial system.
The economy isn't just shaped by reality, it's shaped by what people believe reality will become. If you take away anything from this explainer today, it should be this incredible paradox about human behavior. The financial system is heavily driven by what we think is going to happen next.
It's a self-fulfilling prophecy. If people simply expect inflation to rise, they will rush out to spend their money today before prices go up. And millions of people rushing to buy things instantly causes the exact inflation the government was trying to prevent in the first place. We've all seen micro versions of this, right? Like when people expect a toilet paper shortage, they rush to the store and literally create the shortage themselves. The exact same psychological panic applies to global businesses. If they expect an economic slowdown, they stop investing right now, and that lack of investment actually triggers the slowdown early. Policymakers are constantly fighting against these beliefs. So, because power is distributed across this vast, unpredictable network, we have to ask a pretty big question. If the institutions in the control room are really only guiding the system, who actually moves the world's capital? If the central bank just sets the weather and the government just injects fiscal stimulus, who is making the day-to-day decisions about where trillions of dollars flow?
Real movement happens in the arteries of the financial world, the banking system. So the ultimate question we're left with is this: if governments are just steering the ship, who's actually building the ocean? That is exactly what we're going to need to explore next.